I see that Mike did answer a few of the questions. Mike, maybe if you want to take a minute or two just identifying some pertinent questions that were asked and what you had to say.
Great, sure, will do, Pete. I got a bit, jumped the gun a little bit there. So the first question was, how we think about the Nigerian risk and multi-choice. And I suspect that probably relates to the tax matter that's been very newsworthy for the second part of this year. Certainly what we've seen with these businesses is that often it's having the courage to buy them when the news is a bit negative around Nigeria that proves to be the most fruitful thing to have done in the longer term. So essentially, we think that this matter will be resolved favorably. It is an area where certainly the rules are much clearer around how the tax works in Nigeria, if you would believe it. It's taken longer than expected for us to get to that point, but that's the outcome we're looking for. I think the other point to note is that, say relative to MTN, the importance of Nigeria to multi-choice is actually much less significant. In fact, it's a loss-making business. And, cynically, I raise the question over if the Nigerians absolutely dig their heels in over this, despite what we expect and think about it, whether, multi-choice could literally walk away from that market. I hope it doesn't come to that, but, we're certainly expecting that will be resolved in multi-choice's favor. Another question involves whether we see potential M&A, potential takeout of multi-choice. And I think that relates to the fact that Vivendi has been building a stake in multi-choice. It's now up to about a 15% stake. It's been quite clever at using any pullback in multi-choice as an opportunity to buy up. The problem really is that the South African regulations don't allow a foreign owner of a media asset. So I think it's unlikely you're going to see a complete buyout of multi-choice, but I also think it would be very strange for Vivendi to be sitting happily with a sort of small passive stake. Bear in mind that Vivendi did make a play, we understand, years ago for the African operations, which multi-choice turned down. And I'm asking the question whether possibly you might see Vivendi maybe tender the shares that it's bought in multi-choice in exchange for those African assets in time to come. Remember that, as I said, it looks to us like it's actually valued negatively. So if there was to be a deal like that, it could be hugely value accretive for multi-choice from current levels. And then there was a question that I also answered just around cash generation and how Afrimat is funding its acquisitions. It's been very clever at the way it's done its acquisitions, actually. If you take the Nkomati mine deal, for example, it by the time it sold off the non-core operations that it acquired alongside that mine, it effectively got the mine for almost nothing. The fact that commodity prices have been as strong as they have been, well ahead of what they forecasted, the balance sheet's in actually far better shape to fund these acquisitions that they've made organically. They have indicated that should they see opportunities, and it's not done with acquisitions yet, they may be prepared to issue equity, but we're looking at maybe sort of 7% additional shares. So it's not dramatically material. In fact, may improve the liquidity in the share to some extent. So those are a couple of the questions that I answered online.
Fantastic. Thanks, Mike. There's a question on Alviva and Pinnacle. Somebody with a long memory saying that, but Jeremy, they were bedeviled by EOH-type reputational issues. Have these been forgiven or forgotten by the market? I think we're talking about events that probably happened about 10 years ago. Where there's some accusations about bribes to the South African police force, where the guy making the accusations, I think, landed up working for their main competitor. But that's really a thing of the past. It's had a new CEO for many years, and I don't think really impacts the value or prospect of the business. David, just before we bought Ginkgo, and actually gave us quite a nice entry point, there was a class action suit filed against Ginkgo for failing to disclose that most, if not all, of the company's revenue came from related parties. Thus concealing the near total dependence on related parties. Perhaps you can just put that, it's obviously an issue that we're well on top of and looked at prior to buying the share. Perhaps if you could just put that in context in the way that you're viewing it.
Yeah, look, we take all those things very seriously. So I suppose, this is the thing with the new industry is you're trying to create a lot of other businesses around you that might become dependent on you, right? So in their latest set of results, Ginkgo did disclose that some of their revenues are from third parties. It's about 38%. But the important thing is it's come down dramatically from a year ago. So last year it was just under 60% of their revenues was from third-party companies. So in other words, sorry, not third, but related parties. So those are companies that either they are very closely aligned with, or where their directors might be on the boards of those companies. But you can see now that, and this is something that I've been monitoring, is how is their customer base expanding? And so you can see now related parties is now 37% of revenues in the last quarter. They've picked up some very big customers like Bayer. Chanel is another customer of theirs. Robertet, French fragrance company. So in time, they'll be picking up many, many large customers. And then the related party element will become much smaller, and that will reduce the risk in the business. It's always something you've got to watch for a relatively new business. But, obviously it's something we're watching closely. They are very transparent on this now. So in their last earnings call, they spoke about all of this at length.
Thanks, Dave. Liam, one for you with respect to transaction capital. With second-hand car price inflation having risen sharply, questioned by Nick Rogers, in reaction to the chip shortage and supply chain constraints, would you recommend being patient on transaction capital at current valuations until prices cool off? Or will they have the ability to scale mitigate any car price normalization?
Yeah, so the response to that would be, I don't think we would try and define our edge in terms of identifying transaction capital as an investable portfolio company by trying to sort of make big forecasts on the second-hand car market and things that we probably need to take either their guidance of or just look at circumstance and what's happening around the world. So, just for context, there are places, I think there's certainly some cars in the UK where the price of a second-hand car is the same price as a new car just because there's no supply at the moment. So that clearly is a moment in time, and that set of circumstances is not going to last forever because it makes no sense longer term when the supply eases off, or the supply constraints ease off. In the case of transaction capital, I think way of looking at it would be to treat it like we did with we treated the iron ore price with Afrimat. While the price is elevated, it's not it's the prices of those cars are elevated. It's not necessarily what we had in our base case when we first looked at it, and the ability to grow volume to mitigate some kind of price decline, which we don't think is like severe, as was the case with iron ore, which is probably double the price that we originally thought. With cars, it's certainly not nearly that severe, but we think that they'll more than make up with volumes going forward to mitigate any sort of deflation or slowdown in the growth of prices of second-hand cars. It's far more important to us is the business model and the functioning of that and the offering to the broader market and the appeal of that.
Well, thanks, Liam. And maybe I'll just take two last questions. One from David Faf, which SA resource company is best positioned to take advantage of the growth in EVs? Maybe to extend that to kind of the green climate, where all kinds of electricity transmission needs copper. There you've got a company like Glencore, which has got the highest proportion of copper. Anglo American also sits with quite a bit of copper. Interesting to see that Sibanye. Now, obviously, the platinum companies, they primarily, more than 50% of the PGM metals are being used in internal combustion engines. So they look to for the growth of EVs to be a negative. They're betting on the growth of the hydrogen economy. But you've seen Sibanye invest in lithium and other commodities which are suited to the kind of EV world. And then a last question from Ilza, and this is to Nick Dennis. The price target for Tesla once Gigafactory is operational, and who's going to be the biggest competitor? Traditional internal combustion engine manufacturers or Chinese EV manufacturers like NIO?
Yeah, so look, I don't have a price target. Who knows what the share is going to do and what sort of, how flows are going to go and all of that kind of thing. I have no idea. But look, I would say in terms of competition, I think the legacy players are really going to struggle, and I could see a scenario where it's a bit like the Japanese automakers going into the US, say 30, 40 years ago, and outcompeting the US, the Detroit 3 kind of at the low end, which is you can get these shifts when there's a kind of a new paradigm. That said, I'm not wild about NIO's business model, which is they use a whole battery switch. So they'll take the whole battery pack out of the car and swap you in with a new one. That to me, I think is something that's very difficult to scale. So, I mean, long story short, I think it's really not obvious to me who the number 2 or 3 players are going to be for a long time. And I think Tesla's advantage over the rest of the pack is going to be, they've got a significant lead. It might be a bit different in China because the Chinese government will try to favor their own automakers, and it'll probably make it more favorable for them. And then you've got a handful of players. So, yeah, I wish I could give you a better answer, but it's just like Tesla and then the rest are miles behind.
Great. Thanks, Nick. Guys, we've gone a little bit over our time, so we're going to call it there. We hope you enjoyed the session, and I'll hand back to Dale to say a final goodbye.
Thank you, everybody. We are at time. Just a moment just to thank Pete personally. Pete, thank you for all the time you've given Essentials this year. I think you've been the most regular speaker, so thank you very much. We'd like to take this opportunity to wish all of you a happy new year and a festive season, and hopefully a non-event of a fourth wave. Thank you very much, and goodbye.